Risk Parity land. This is Justin with Risk Parity Chronicles with a quick tutorial on how to do an asset swap. This is a basic portfolio management technique that is not specific to risk parity. However, since risk parity involves targeted asset allocations, it's one that you'll wind up using a lot. I use it a couple times a year, mostly to add at this stage, but it's also used for withdrawals. The withdrawal type of this technique is a bit trickier, so that's what I'll be focusing on here. The asset swap is a simple technique, but there's one catch. If your swap involves a loss in a taxable account, then you need to really be aware of the wash sale restrictions. They are not especially complicated, they're not especially difficult to avoid, but if you don't know the rule exists, it's easy to fall into the trap. So be aware of the rule, and once you know it, it's easy to navigate around it. So the wash sale rule is important and it's nuanced, so I've made a separate video about that, which you will want to watch right after this one if your swap involves a loss in a taxable account. So here I'll be covering the basic problem of how do you withdraw money from a portfolio when the assets you'd like to sell are in an account that you don't want to touch. To give an example, you have asset A in your regular brokerage, meaning it's straightforward to withdraw, no penalties. Of course, you'll have to pay taxes on a gain if you have it, but you don't want to sell the particular asset that is in that brokerage account, even though the account itself is the one you want to touch. Meanwhile, you have asset B, which is the asset you do want to sell, but it's in a tax-protected retirement account. So you have this issue where the thing you want to sell is in the wrong account, and the stuff that's in the right account is what you don't want to sell. So what you're going to do is a three-step process known as an asset swap. As I said, I'll be covering the withdrawal scenario, and I'll finish with a brief look at what to do when you want to add. Now, how does it work? We'll start here with your basic asset allocation, sort of risk parity style, with only 3 asset classes. If you have 20, it works the same way. You just have to identify which ones you're interested in moving around. You want 55% stocks, 10% gold, and 35% bonds. You started off with $1 million, but due to the dismal performance of 2022, you are down 20%, and now you have $800,000 total. Now, of that money, you have 3 different asset classes. You have 3 different assets, and they happen to be in 2 different accounts. In your Roth IRA, which you obviously don't want to touch until you're retired, you have $500,000 in stocks and $100,000 in gold. Your brokerage account, meanwhile, has all your bonds worth $200,000 there. So the way your portfolio looks together, you have here your target percentages and your current percentages and your relative difference. Gold has done the best. The numbers are a little different just because of the decimal places. You have too much of gold and you're really low on bonds. But here, your bonds are in the account that you can easily withdraw from. So here's what you do. Let's say you need $20,000 in cash. You have too much in gold, so that's the asset to sell. The available asset is bonds and in your brokerage, so you're gonna have to swap them. Step 1, in your Roth IRA, sell $20,000 in gold. Now, sell, but don't withdraw, if that makes sense. You're going to sell it and the money will go into your sweep account, which is your transitional account within your Roth IRA. So you went from $100,000 down to $80,000, and now you have $20,000 sitting there in your sweep account. Right away, you can, in your Roth IRA, buy $20,000 of a different bond fund. This is to avoid the wash sale restriction, as you'll learn about in the next video. As you'll notice here, I have long-term bonds, TLT, in my brokerage account, and I'm going to buy intermediate term bonds within this Roth IRA. So the long-term bonds are durations of 20 years or so, and the intermediate term bonds are 5, 7, 10 years, around there. So these are not substantially identical, and I've switched out my long-term exposure for a little bit more of intermediate term exposure. Step 3, I will then sell $20,000 of the long-term bonds in the brokerage account, and then this will become cash that I can use. Now, so summing it all up, I got my $20,000 in cash. I wound up selling the gold to get it. My gold went from $100,000 in total down to $80,000, and I wound up with the same amount in bonds as before, now split over two different accounts and two different particular assets. You'll see here the percentages are now different because now I've lost the money out of gold. Now, with this swap, if those long-term bonds actually had a capital gain, then no problem. You don't need to worry about the wash sale rule. It only applies if you're taking a loss in that capital, in that brokerage account, as you would have, say, this year with my example. If you do sell at the loss, then that's where the wash sale rules kick in. So please watch the video for more on that. Now, next, what about additions? And this is what I do more of these days because my 401k doesn't have a great selection of choices. Out of the 30 things in it, I think only 5 are worth investing in. So I'm frequently having to move and adjust and play around with the money that I add into a brokerage account, and then I have to adjust it with the money in the 401k. So this is going to show you a little bit about how to do that. In this case, you don't need to worry about wash sale rules in this case because you're adding money and there's no sale from a taxable account. In this case, I would just add $20,000 in gold to my brokerage account, and then I would sell, meaning move into a sweep account, $20,000 of gold in the Roth IRA, and then use that money to get $20,000 of bonds. So there you go, easy peasy. So if you have any follow-up questions about this asset swap, feel free. You can email me here at riskparitychronicles@gmail.com. Of course, continue to follow my blog at riskparitychronicles.com or on Twitter at rp_chronicles. Thanks. Bye-bye.